So can you explain a little more about the Roth conversion for 5 years? How should I plan for FIRE with the early retirement using a Roth conversion? So 5-year Roth conversion is when you have money inside your traditional IRA, traditional 401k, 403b, TSP, anything in pre-tax, right? So traditional is on pre-tax and Roth is on after-tax. So there's a conversion strategy that you can move your, let's say, 401k from traditional 401k, and then you can convert that to Roth IRA by paying taxes now so that you can let that money grow inside Roth tax-free. And then when you turn 59 and a half, you can enjoy the earnings and interest tax-free as well, okay? So how that works is that when let me share the screen first. So I'm gonna just give you an example. Let's say you have a traditional 401k, then you've been saving and you have we'll go with $500,000 invested, all right? And that is making you about 8% average annual return, okay? Now you are getting ready, you're retired and you wanna move that traditional 401k to a Roth IRA. Now, so the first step is to move that traditional 401k to traditional IRA. And then you can convert traditional IRA to Roth IRA. Remember, this right here is a rollover, and this right here is called a conversion. Okay. So anytime you make a conversion from traditional IRA to Roth IRA, you're gonna have to pay federal income tax. So if you convert all $500,000, you're gonna pay federal income tax for $500,000. That puts you at a marginal tax rate pretty close to 35%. And I don't know what the effective tax rate is going to be depending on that. So what most retirees choose to do is they actually wait until retirement to do it, because your income is going to be a lot lower than when you're working, okay? Assuming. Now, do you want to convert all $500,000 at the same time? No, right? Because if you pay income tax, $500,000, I mean, let's just say 35% marginal tax rate, that would be hefty. So what people do is actually do 500K, and let me see if I can do divide. There we go. Divided by, let's say 10 years. That would put you at about $50,000 a year. Now, paying income tax on 50K is, let's say you're single, that would put you at about, well, just above 12%, so at about 22% marginal tax rate. That is way better than 35%. Now, this is not any specific financial advice or tax advice to you, but just keep that in mind. And if you're married, filing your taxes jointly, then it would be 12%, or married, filing jointly, okay? For 22% would be single, or married, filing separately. So when you plan for retirement, let's say you wanna make that money work and you have that pot of money going into your Roth every single year. I mean, you just pay minimal taxes as little as possible. It really depends on the age that you're going to be retiring at. So let's say you retire at age 55, just use that as an example. You can just directly take money out of your 401k under the rule of 55. So it wouldn't make sense for you to really convert that unless that is a source of income, that you have multiple sources of income that you're trying to minimize taxes later on in your retirement. It really depends on your situation. Okay. So this is not a one size fits all plan, just kind of giving you an example. So if you have a lot of money invested in your traditional 401k, just remember that you have the rule of 55, that you don't pay any penalty on the 401k withdrawal, but you will pay federal and state income tax. So what do you think is better? Investing $500 a month, making 10% return, or investing $1,000 a month, making a 7% return on investment? You can't figure out how much you can invest without a budget. There's no way around it. I personally tested out the budgeting app called YNAB, and it's not just an app that can track your income and expenses, but it can even help you create a plan to pay down your student loans, car loans, personal loans, or credit cards a lot faster. So if you're ready to change your life by getting out of the paycheck to paycheck cycle, you can get a free trial without any credit card information by using the link in the description below. Now, let's say you retire at age 50. So what do you do with the age 50? Now, when that happens is if you have traditional 401k for 500K, then you can do 50K. I'm just giving you an example here. Let's say 50K a year, age 50, and then 50K a year for age 51, so on and so forth. So when you get to age 55, then you can take that money, 50K out, tax free. That's where the 5-year conversion rule comes in. when, let's say I retire in 2024 and I convert $50,000 from the traditional 401k to the Roth IRA, I can't touch that money penalty-free and tax-free until 5 years later. So 2024, so I can take that money out in 2029. There's no age rule for the tax conversion, okay? Because I already paid taxes on that. Keep that in mind. It doesn't matter if it's an earnings and interest, because when you convert that 401k out of a traditional 401k into Roth IRA, again, that is, you're paying taxes on the entirety of that conversion. If you convert $100,000, you pay taxes on the $100,000. It's federal income tax, not capital gains tax. You got to keep that in mind, because it is, you put that money in there in pre-tax contributions. That's really the key thing here. So when you put money into Roth IRA, okay, let's say at age 55, you have $50,000 in converted and met 5-year rule, okay? So what that means is that you have met the 5-year rule because you converted that from 2024, and then in 2029, and it doesn't matter what month it is, if I convert it on June 12th, 2024, I can take that money out as of January 1st, 2029, because I met the 5-year rule and I already paid taxes for the tax year 2024. You pay taxes now so that you don't pay taxes later. So you can do that 5-year conversion strategy. So by age 56, I'm going to have another 50K tax-free. Age 57, another 50K tax-free. So that's going to be really key when it comes to retirement planning, because you want to minimize your taxes as much as you can. And if you can just kind of like plan out, 58, 59, and then age 60, I'm sorry, that would be 5 years already. So 55, 56, 57, 58, 59. And if you can make $50,000 every single year tax-free, that's going to be really huge for your retirement planning, because you may have other taxable income coming in from traditional 401k that you're taking out, or maybe you have real estate income during your early retirement, or you may have pension income that comes in earlier if you're a policeman, police officer, firefighter, or whatnot. So just keep that in mind, because your pension income is going to be taxable income. And having these, and if you convert early, and you can kind of set your timeline for 5 years, but when you convert at age 50, you're doing it at 50, you're withdrawing at 55. If you convert at 51, you're going to withdraw at 56. You just continuously convert until you run out of traditional 401k. So I hope that answers your question. Really good question. Having 401k and Roth IRA, those are the two core accounts that you want to have for your FIRE journey, is to have a 401k with your employer, and then your Roth IRA or traditional IRA, because those are individual retirement accounts. 401k is a employer-sponsored retirement account. So those are the two big differences. So just make sure you keep that in mind. But great question.